On Wednesday, the IMF came out and downgraded U.S. growth from 2.2% to 1.6% for the year. That's a pretty hefty downgrade, but the IMF sees subdued growth globally. For our next guest, Chris Versace, Chief Investment Officer at Tematica Research, this slowdown matters in particular because it hurts corporate earnings. So I asked him what his sense is as to how the U.S. is really holding up. Here's what he had to say.
Let's go back a little bit, right? So we clearly hit a soft patch in the summer, and as we're emerging, we're starting to get some mixed data. You know, we've got the market economics PMI data, as well as, for manufacturing and services. We got the ISM manufacturing and services, and it looks like manufacturing is doing this seasonal pickup a little bit out of the summer slowdown, but services jumped up quite a bit. So there might be some hope there as to the maybe an acceleration for part of the economy. But here's the thing, Amira, 1 month does not a trend make. So we really need to see a lot more data before we go, all right, yeah, okay, we're back. We're starting to see it pick up yet again because, let's be honest, we've been head-faked way too many times with this economy. So, for us looking towards the back half of the year, or the balance of the year, I should say, we want to see what's going on with retail sales. Is the consumer spending? Are they really opening up in their wallets? Where are they doing this? Yeah. Because the last few months we've seen the consumer really hasn't been there. And it's understandable when you start to look at some of the pieces behind that. We've seen a real pickup in consumer debt levels, right? We're seeing, starting to see the bubble start to, crack maybe a little bit or get a little frothy, if you will, for auto loans. We're seeing, again, student debt. We're not seeing real robust job growth, wage creation. So there's a lot of concern about the consumer. And remember, the consumer is about 2/3 of the economy. And on the business side, business investment hasn't been there. And I don't think we're going to see businesses really start to open up and spend until we get past the election.
Right. And that's a big thing I'm going to ask you about in a little bit. Of course, a lot of unanswered questions. We did have 2 fairly sluggish quarters. Of course, the consensus for the second half of the year has been we're going to see a rebound or reversal of sorts.
We always see that, though.
Right, but I wanted to ask you, I read that you actually believe that, it's not going to necessarily meet expectations. So tell me why you think that.
Well, what we do is we do something very novel, very different. We actually look at the data. So we don't say this is what we want the data to say and then back into it, right? We look at the data and then we formulate our opinion based on that.
So you mean you're a realist, not an optimist, Eric?
Yes.
Okay.
I'm not a pessimist either. I just try to be a straight shooter and take a look at the data, like I said. So we haven't seen that pronounced pickup. So we're going to wait and see what happens. But, the other thing is you need to connect the dots, and a lot of people don't do that. So when I imagine we're going to talk about this because we're on the cusp of earnings season, but, as we take a look at the earnings expectations for not only what we're going to get when the September quarter is reported, but the all-important guidance aspect for the December quarter, December quarter earnings, S&P 500 are up 6% from the third quarter, but we've had 6 consecutive quarters of contracting earnings. And then we see this sluggish economy, so you connect the dots and you go, how is this going to happen?
Right. And let me ask you specifically about banking stocks, because a lot of people are talking about that right now, given what we're seeing happen with Wells Fargo and Deutsche Bank. They are performing slightly better here than they are in Europe, that you can argue. But how indicative do you think bank earnings really are of the 2 troubled banks? I mean, how do you really see them impacting their respective markets, both in the U.S. and in Europe?
Well, I think the Wells Fargo aspect is very company specific. So I think we can kind of put that to the side. Deutsche Bank, it's one of those things, it's like a string. If we pull on it, we start to understand the loans that they're exposed to and how
interconnected
it is and how vast it is, then we have to really start taking another look at that. But I will tell you this, that we at Tematica have steered clear of all financial stocks, particularly banks in particular. To us, you have to remember, we don't necessarily go sector focused. We tend to look at the world from a thematic perspective. So from a thematic perspective, a bank is a bank, okay, low rates, hard to get excited about banking stocks for us. Rather, if we think about the aging of the population, the cash-strapped consumer, and this big under-savings that we have for retirement in this country, wow, now all of a sudden, what about Charles Schwab? What about TD Ameritrade? That's how we tend to approach the world.
Are low rates really hurting them?
Hurting?
Banks here.
Oh, I think that they absolutely are. There's no question about it. And I think that, again, we've got another round of hesitancy in the economy, so I wouldn't be surprised if their loans kind of get hit a little bit, reducing their fee income. So not all that excited about banks, but rest assured that if the Fed officials continue to jawbone about a potential December rate hike, you might see those stocks start to get a little bit ahead of themselves.
Yeah. Somebody tweeted at me and said about a story I posted about ATM fees going up.
Oh, yeah.
And they said, well, that's probably happening because they're just not getting enough money, you know, within a low rate environment.
Well,
do you think that has something to do with it?
I think that might have something to do with it. Remember, too, there are some banks that are turning around and they're going, you want to use the teller? You're going to pay for that.
Right.
Which, to me, is ridiculous. But, you know, it's their idea to try to boost fees, to boost revenue.
Individual costs for every single service possible.
Yeah, but you know what? I think they have a bigger issue longer term. Banks, which is if you think about their real estate portfolio and you think about the push of technology and what more and more people are doing, I don't know about you, but I haven't stepped foot in a bank in I don't know how long because I use my smartphone and I actually deposit checks when I get checks and things like that. So I think long term, these banks have a big real estate portfolio problem.
Yeah, that's a really good point. I think less and less people are actually going to the ATM these days, and so maybe they need to make up for those lost fees. But let me ask you about other sectors.
Sure.
We have tech, retail, construction. What sectors stand out to you, weak or strong, in this earnings season?
Sure. So, you know, as we get into it, again, we're kind of following the data. So we look on the retail side, you know, like we said earlier, retail sales, you look at July, August, not that robust across the board. Pockets of strength for sure. For example, like, you know, pharmacies and healthcare and services, very strong. Online has been very strong on retail sales. So, you know, to me, that means, ooh, Amazon.
Right.
But we also take a look at some other data on as it relates to the consumer, and we see that for restaurants, particularly quick service, fast casual, traffic has been falling over the last several months. So that is not good, but people need to eat, right? So what does that mean? Well, maybe we're going to take a look at Kroger, for example. Maybe we'll take a look at Costco. But we also know, too, that people are shifting how they buy, what they buy, to things that are more what we call food with integrity, which means organic, natural, paleo, these alternatives.
The healthy consumer.
Correct. So for us, you know, a healthy consumer, maybe they would have gone to Chipotle, but we're not eating out as much. Maybe that means we're buying snacks and other offerings from United Natural Foods.